but we're actually going to back up one slide. I must have hit it accidentally here. So today we want to talk about some things that we all tend to struggle with. But before we do, I want to introduce your webinar presenters today. First of all, Legacy Law Firm is sponsoring this along with Strategic Planning Corporation. Legacy and Strategic are partnering to bring to our clients best in class of estate and financial planning services, money management, insurance, and that sort of stuff. And the reason we do that are the two principals. Philip Corson with Legacy Law Firm, who is also an investment advisor representative of Strategic Planning Corporation, and then myself, who sometimes plays an attorney in the real world, sometimes on TV. It's accidental. Don't mean anything by it in case the state bar is watching. But no, seriously, I'm not an attorney, but I am an investment advisor representative also with Strategic Planning Corporation. And we both have many years of helping people to achieve their objectives in their lifetimes and as they pass on assets to their family members and so forth. So that's what we're all about. We're here because we love working with people to help them accomplish their goals and objectives and realize their dreams. So we hope that what we're doing today moves that along even further. We really want you to be confident in what you're doing with us, not just to be a follower and just hey, I trust you and you do whatever you want. Philip and I might fall off the edge of the earth if we were flat earth theorists, one day. And so you'd want somebody to know what's going on, and that can be you. So that's why we do these webinars and in-person seminars, which I believe, Philip, if I'm not mistaken, we have our next in-person one coming up sometime around the middle of March, but we'll get more details out to you on that soon.
Yep.
Great. So let's look at what we're going to be talking about today. And as I may have mentioned, excuse me, we all kind of tend to struggle with this sometimes, and that's telling what I want to refer to as the story of returns. Returns, or what we make on our investments, are pretty abstract to most people, and the returns that people think are reasonable or expected can vary very widely, wildly. So the name of this presentation could actually be level setting returns, and to do that we need to understand what a realistic return is. They're not necessarily the same for everybody in every situation, are they? There's a lot about returns that we could unpack, and it's often confusing and clouds our judgment about what we do when we're thinking about what we expect returns to be and what they are. And so sometimes, like when we're with friends or family, maybe at a party or at a holiday gathering or something like that, sometimes discussions will come up about returns that somebody's gotten on something. I know a lot of times I'm with my son and we enjoy talking about some of the things that we've been doing and so forth. And, if we don't understand what returns are and where they come from and all that kind of stuff, it can cause us just to kind of be a wallflower, just to hang back, not participate in the conversation. So this guy, Michael Scott, this is a millennial slide, by the way. I really don't understand this. No, I have millennial kids, so I mean, I've seen this stuff. We feel like this guy, Michael Scott, where we're just completely left out when all of our friends or our family members are bragging about how great returns they've gotten. And, the excuses for why we feel left out. It's because we feel like our strategy, what we do, strategic planning and legacy law, is that it's just plain vanilla. It's just simple. There's nothing fancy or exciting about it. And so how can I compete with my brother-in-law when he tells me he invested in some deal that he's made triple his money on it, and he's doing it every year? He's doubling his money at least every year. And I don't even maybe know how to tell what my returns are or where they come from or anything like that. And so I'm just totally left out of the conversation. That sounds like a good reason not to participate because we don't understand what we're talking about, but we can take all that away. See, if our strategy is so plain that everybody could understand it, if we explained it, then we'd be able to have some great discussions with our friends and family without any problem. So we just need to understand it so that we can present it accurately and helpfully. By the way, if you do have a brother-in-law that at your last holiday gathering maybe was talking about something where he was making triple-digit returns, you just in the Q&A, if you'll put his phone number in there, I'd like to call him. I'd love to know how he's doing that. But seriously, consistently doing that is pretty much been proved to be impossible. So last thing we're going to talk about today is helping ourselves truly understand returns. So how do we do this? Well, first, we're going to talk about return misconceptions that exist. This is not a new phenomenon. It's been going on forever. There's always going to be new misconceptions about returns that crop up. And then the second thing we're going to talk about is market rates of return. What is a market rate of return? Knowing what it is, knowing what a market is, knowing what a market rate of return is, that will help us properly set expectations for ourselves and for other people so that you're set up for a lifetime of success and you avoid all the investor traps of timing the market, trying to pick the right investments to be in, security selection, and then chasing managers' performance that may or may not continue. So going back to return misconceptions, going way back, I mean, as long as people have been on the earth, I guess, and talking about this kind of stuff, there's been misconceptions about returns, where they come from, what they are, and how we get our part of those returns. So there's a study that was done a while back, and not too long ago, I think it's just in the last few years, where people assumed that they were getting 21 to 24%. That was the range of annual returns they thought they were getting during that 2020 to 2021 return or period, I should say. And, you know, when investment advisors were polled, they even felt like, yeah, we were getting some good returns. Investors thought that's what they were going to get going forward. Even advisors thought 15% a year wasn't unreasonable. And so, you know, that's kind of some of the crazy stuff that's out there. So let me start by asking you, what is a good rate of return? So if you'll take a minute, and hopefully you got your Q&A up, just throw out some answers in the Q&A as to what you believe is a good rate of return. In other words, the amount of money you should make on your investments on average, year in, year out. Not that you're going to make the same thing every year, consistently every year, but just what's a good average rate of return that you would like to think would be reasonable. So we've got some coming in here. I've got a 12%. Somebody else is typing an answer. 8 to 10%. 12%. 5 to 7%. 8 to 10 again. So yeah, we've got them, interestingly, let's say 4%. There you go. So 6. All right, we're getting them all over the place, right? So see how much it can differ in this group, you know, a group that most of you are invested with us, if not all of you, I think. And so it should be somewhat of a group of like-minded investors, not necessarily looking for the same kind of structure, but you understand what we're doing. And in this group, you have a fairly wide variety from 4% up to 12% as a range of expected average returns that might occur. And so even in a group like this, you think how different, you know, looking at us, and now think about how different it would be in the whole vast world of investors out there that have different investment strategies and expectations. And if we can't see among ourselves a consensus of what a good market rate of return is, then who really can? So with that being said, it's easy to see how people, ourselves included, can be seduced by stories that people tell, one-off stories of some great big grand slam that they hit on a deal. And so, you know, that's one of the things that can be so disconcerting. And hearing those kinds of things and chasing great returns, not just good returns, but great returns, it's changed throughout time at all levels. So let's look back a little bit. And in the 1630s, the thinking was for a time there that a good return was roughly 20-fold on your investment. I didn't say 20%, but 20 times, or a 2,000% return. So if you invested $1, it became $20 overnight. Does anybody know the period we're talking about? Well, I won't take the time for you to respond, but I'll just give it to you. It was called the tulip mania. Now, I don't want to bore you too much on this. We've talked about it in the past, but most of you know that in Holland back in the 1630s, and quite frankly, most of Europe, they got into this thing of buying and selling tulips. A market developed for it. And people were getting just crazy wealthy on trading tulips. So now this is tulip bulbs, okay? Not the flower itself, but just the bulb. It hadn't even blossomed yet or germinated. So not only were they getting insanely wealthy, but everybody that invested expected to make at least 20% return, or not 20%, but 20 times return on their money. And they did do that until they didn't. So move the timeline forward to the 1980s. A good return in Japan during the 80s was expected to be about 30%. We'd all take that as a great or a good market rate of return, I think. Anybody remember what that period was? Yep, it was the Japanese real estate and stock market bubble of the 80s. They had seen a humongous run up in the prices, a boom in their real estate market, and that impacted the entire Japanese economy, caused the stock market to just skyrocket for almost a decade. And people made obscene amounts of money, and even just the average guy would make good market returns for this period in the 30% range. So anything less than that, people felt like you were missing out. So that might sound familiar. How about in the United States? If we go forward to the 1990s, our returns were expected to be north of 25%, particularly in the last half of the 90s, 95 to 2000. And some of you probably know the reason or the cause for this large return expectation. And this is what it was. It was the tech bubble. Really, back then, it seemed as though there wasn't anything you couldn't invest in and lose money. I mean, and not lose money. I mean, you just made hand over fist money. People were talking about secretaries of these .com companies becoming billionaires and crazy things like that because of the stock options they got. And everybody that touched anything seemed to get a good return on their investments in the triple-digit range, over at least over some period of time. And for a lot of people, this created generational wealth, and it caused anyone that was getting less than that to feel like they were missing the boat. I can remember some physicians that were clients at the time in their pension plan, and they wanted to just really jump out there about 1999 because they had just seen these triple digits, 25, 30, 37% rates of return annually happening. And they wanted to bump up from what they had been averaging. And so if they felt like they were missing the boat. However, in the 2000s, and not too far into the 2000s, it started about March of that year, there was a different feeling about returns. We went from the late 90s, the second half of the 90s, where a 25% return was great and expected, to losing probably about 3% a year for an entire decade. Investors tended to think that the market was something to be afraid of. They ran from it. In fact, most people saw negative returns in their U.S. holdings. Not all the time period returns are great. some people got out of the market entirely. So that was what was going on in the US in the 2000s, and we called it the dead decade. And you can see there was a lot going on in the dead decade. First off, remember back in the 90s, you had the dot-com tech bubble and all that sort of thing. And so in the 2000s, we were kind of recovering from that. I mean, early 2000s, we were getting killed by it. Excuse me. But then we were recovering from that tech bubble and things were kind of normalizing. And then 9/11 happened. So in the middle of all that recovery type thing, and that's caused the market to drop even further. During the 2000 decade, we had the slowest growth in GDP, or gross domestic product, that we had had in decades. The job market was not good. You had a housing market collapse toward the end of that decade, and then a prolonged recession that we just didn't seem to be able to pull out of. And for many investors during this time, it felt like the stock market was never going to recover. People were pulling all their assets out. They were looking for alternative ways to build wealth for the future. And that lasted long enough for people, quite frankly, to miss the start of our more recent bull market, where people now expect something totally different. Today, and for the past 5 years or so, up until 2022, this last year, people thought an acceptable good rate of return was just a paltry 80%. And you may be trying to guess what was it that was creating this kind of expectation of 80% annual returns. What was the hottest thing that everybody wanted to invest in? Whoops, sorry about that. And everybody's being told to invest in. Well, it was cryptocurrency. And most of us know of a person that was an early investor in crypto, and they made a ton of money. I mean, just ridiculous amounts of money. So they had that made, and is this really a good barometer of what a good market rate of return is? Should these kinds of expectations that we've been talking about, going back 500 years and 30 years and 5 years, whatever, is this what should be our expectation for the market and for the returns? Because at one time or another, these amounts were what were anticipated as being good market rates of return. And these times aren't indicative of a truly good market rate of return. And the reason it's not is because the markets during these times did things that brought to our attention certain people that were just getting wealthy out of any reasonable expectation for that to happen. And we know these, though, not because of that, but because of the back end of it, where people know intuitively what we're talking about. And that's because of what happened, not with the people that got rich and rode off into the sunset and all that, and were happy the rest of their days and all that kind of good stuff. But it was the exceptions. They were the exception. And we're always looking at the exception, and we're thinking, gee, that could be us. We could do that. But we're not. The reason we remember these times is not because of those exceptions. We're not just looking back at the good times fondly, but what's happened is it's because we look back at these returns and we didn't appreciate until later that they were just too good to be true. For a lifetime of investing, they are just not to be believable. Instead of chasing a story that we wanted to chase maybe at that time to make it our own story of success, we should have been trying to understand what to truly expect from the market during these times where you had these great run-ups in some segment of the market and then a crash. And so we remember these times in our history because of all the people that jumped in too late. they watched what was going on. They were all excited about it, and they just jumped in too late, and they missed it. And they were the ones left holding the bag. It's almost like a Ponzi scheme, where you, or a pyramid scheme, where you're getting all these people in and finally build it to the top, and then everybody that got the early money in pulls out. Not necessarily that's what's happened in these circumstances we gave, but people lost their life savings and ruined their investment futures, coming out worse for the wear because they believed that something that was too good to be true was actually going to be true for them. So it's easy to get swept up in these kind of things and to be enamored with a booming market. Sometimes we'll even spend time daydreaming about what we do with the investments if we did catch one of these wild ride chariots and take off, and we think about how it would change our lives, the lives of our loved ones, and it's a real temptation to never really pause and think about, well, what's the downside? If we did do that, the destruction that occurs in these big run-ups when they peter out and then they fall, it could be greatly reduced. So, when that does happen, we do tend to sit back and we remember things like the tulip mania, where those 20-fold returns fell off a cliff instantaneously. People, they saw this happening early on in 1636 and 37, and they jumped in, and they were going to get a great market rate of return, 20-fold. By February, they had already missed it. This February of 1637. Instead of getting the returns that they had been hearing about, watching happen, the majority of people, they lost everything and they struggled to recover. You can see from February 3rd to May 1st. I mean, that market just fell off a cliff. There was nobody willing to pay those exorbitant prices anymore. And unfortunately, in this 2-3 month period right here, a lot of people right here, I'm sorry, I was not looking at the right screen. A lot of people jumped in here and got some return, but then it was just, the drop was too fast. I mean, look at just 2 days, what happened. Look at 6 days, a week, and it's already below where people invested even back here. So it was really crazy, and people did lose a lot. Japan, the housing bubble there, the downside of it can be seen that and after witnessing good returns of over 30% for many years, then people started pouring their money in, and they would put their life savings into these Japanese markets, real estate and the stock market, so they get their share of a good return. And by 1990, however, they were the ones that were left holding the bag, and they lost the majority of what they put in. They chased what seemed like a sure thing, but unfortunately got bitten, and it stayed down for quite some time. You can see how this market just continued to just putter along and just gradually decline over a good 15 to 20 years. And then, of course, in the US, we all remember what happened in the 90s. We saw annual growth like we'd never seen before. Good rate of return was triple digits, I should say, over 5 years from 95 to 2000. And I mean, I was here. I was in this market time working with people, and I had folks that started talking in 1998, 1999, 2000 about, I need to get into this. I mean, it's obvious it's going on forever. This .com thing is crazy. It's wonderful. It's the future of investing. And so once people convince themselves that that's what they should continue to expect, this 25% plus a year return, they started pouring money into the market. And what turned out was a ton of loss for the majority of the investors. And it started what was known as the dead decade, where people really could think of a good rate of return as just being able to keep up with inflation, not inflation like we're having today, but inflation back then in the 3% range. And the inflation rate we have today, a lot of people after 2022 would kind of start to think that's not a bad annual rate of return. So we look at the effects of an opposite market run during the period of 2000 to 2009. You can see on this chart, 2000 here to 2009. This was the bottom, March of 2009. Everybody was just kind of hemorrhaging money, and year after year for almost a full decade, they were seeing negative returns, and it seemed like we'd hit a ceiling, that this was the pinnacle. We weren't going to be able to jump above this in the U.S. markets. And so people jumped ship. A ton of people got out. And what followed after that bottom in March of 2009, and it continued up until this last year, was maybe the greatest wealth transfer from the people that were impatient and jumped out of the market to try and protect themselves, look for alternatives or what have you. Money markets, bonds, gold, precious metals, what have you. The transfer of wealth came from them to the people that were patient investors and stayed the course in the market. And they've gotten since then a 200% return on their money through 2021. You can see here at the end, we have a little bit of a downturn for 22. Of course, so far this year, we've had a little turn back, starting back around October of last year. And but still 200% since that bottom. Whoops, I'm sorry. For some reason, I keep clicking that. That bottom in 2009 back here. So coming to today, we look at the cryptocurrency record, and you can see that I'll try and do this without touching it accidentally, but June of 2020, right in here, until June of 21 or July. Yeah, I guess it's June of 21. The market just did this number. I mean, just like straight up run. And everybody was thinking it was going to replicate. It's going to go off the chart up here at the top, and they'd be set for life. We do know some people that personally that did make it all, and it was made it that much more tantalizing to those that hadn't. And I'll tell you this, just for full disclosure, I had a family member that had made just an exorbitant amount of money in this. And so I thought, I need to understand what this is. So I put a couple of $1,000s into Bitcoin and Ethereum, a couple of the cryptocurrencies. And I haven't looked at it lately, but I was down over 50% on it. So, I probably did it, let's see, where did I have done that? Probably somewhere right around here when it did this little downturn. And I thought, oh, good, it's a little breather, jump in there. Trying to be my market time myself on this stuff that means nothing to me. It's not for retirement or my future, just something to be able to see what happens with it. And so then I've come down dramatically from there. So when you look at it too, from February 8th of 2022, and I think that was the top right up here, the very pinnacle, roughly 55% of Bitcoin investors, and that's not FTX, that went bankrupt, and others that did, but just in Bitcoin, they're underwater. And that's according to a cryptocurrency investment firm called 21 Shares. And it's even worse now. That was February of 2022. We're almost a year later. It's even worse. So we know these markets, not because they had good rates of return. We remember because of the lasting damage that has been done to a number of investors. And we're all exposed to getting wooed by these return misconceptions. In fact, it's really interesting. There's people that have been calling for the government to recognize cryptocurrency as a currency so they can take tax losses on it and all that kind of stuff. So a lot of mess there. But I will tell you this, if you asked me back in the 90s what a good market rate of return was, I would have told you probably 300% or almost infinity. So let me tell you my story about making this mistake based on return misconceptions. This company here, Edgate, was a firm that I helped start, and along with a number of other folks, and I was on their board of directors. I was an investor, and quite frankly, over several years that we were building this company, which was the gold standard. It has become the gold standard in matching up curriculum standards with student curriculum and academic curriculum and all online for teachers, parents, and students to collaborate within that sphere. Edgate was getting ready to go public in March of 2000, in a company that you may recall. They're bankrupt now. They went out during this tech bubble bursting. Called Bear Stearns was taking Edgate public. We had prepared the draft or the document called an S1 to file with the Securities and Exchange Commission. And me and my other investors were going to be gazillionaires. It was quite a greed trip. We got that thing ready. I had been funding the company by putting all of my retirement funds in there. Other money I could get up with. I took a second mortgage on a house. I made available my American Express card. We were running $60,000 a month on that, and in expenses, and paying payroll and all kinds of things. And with the tech bubble starting, Bear Stearns said, let's hold off a month. There's something weird happening in the market. We'll wait and see what happens. A month went by. They said, give it a little more time. April, May, and they say, you're not going to do an IPO, an initial public offering in the summer. We'll come back in the fall, and it was just worse in 2000. And so they pulled out. So we went hunting for private money rather than public money by doing an initial public offering. We went and found an investor in New York, a firm, interesting name, but I won't get down that rabbit hole. But got this firm to invest $75 million in us, and that would keep us going until we got through this bump in the road with the stock market and we could go public again. And they were going to fund us on October 15th, 2001. In the meantime, I've been taking on more debt, keeping the company going, not getting paid anything. And so it was very stressful on our family. But the end game was I was going to be a gazillionaire, and so take care of everything our family needed. September 11, 2001 occurred, and the company that was investing in us was 3 blocks off the World Trade Center, and they pulled out a few weeks later. We bankrupted that company in, I believe it was May of 2022, about 6 months later, or 8 months later, whatever it was. And they asked me to run the bankruptcy and try and sell Edgate to someone to try and pay back salaries that hadn't been able to be paid, and hopefully recoup some of the funds for investors. We were able to sell the company to a group out in Texas. They since have passed it on to another group, and it is a thriving company. But my genius of putting all my eggs into one basket at that one time did not pay off, and I didn't get the payoff of this company being successful and still running down the road. So this whole thing was all it was just gambling versus investing. And it's good to remind ourselves that there is a huge difference between gambling and investing. It's so hard when you're in the middle of gambling to understand that you are doing it in the present. It's so much easier to look back in time and see, oh my goodness, all that was just gambling with my future. I walked away from that $600,000 or so in debt, and all we managed to pay that off and accumulate some money again. But it was quite a lesson. And gambling is getting into an investment fallacy and chasing hot markets like tulip mania, the Japanese housing bubble, tech bubble, being a money manager like me in the 1990s, or trying to pick certain stocks and investing all your money into one stock or into cryptocurrency. So what will help us go from gambling to investing? Well, it's understanding what a market rate of return is. So let me read this. or I'll read it in a minute. But here's where we're going to go now is what is a market rate of return. So that's what we're going to do in the second phase. Let's take some time and be sure we understand what real returns and appropriate market rates of return are. So first, we need to understand what is a market. Well, the truth, or more precisely, an accurate understanding of reality is the essential foundation for any good outcome. So this quote goes great here because without a foundation of understanding returns, it's really easy to fall into the next misconception about returns. So to have a good outcome, we need to fully understand what we're doing, and we need to understand the expectations we have, and we need to know that they need to be based in reality. So any ideas what I mean when I say a market? Anybody have any thoughts? Put it in the Q&A. What is a market? Go ahead and respond there if you can. I'm looking. I'm waiting for somebody to say something.
Mike, I'm sorry I cut out. Our internet must have gone out, but I'm back.
Good. Sorry about that, Philip.
That's okay, but my video's not on, but nobody's missing anything great there. So.
I'm sorry, I didn't realize. I thought you just muted yourself there. Sorry. So let's see. I think we're getting some responses down here. I just say, yeah, place to invest your money is one definition for market. Technically, a market's a place where two parties, multiple parties can gather and facilitate the exchange of goods and services. Usually that's buyers and sellers, people that want something, people that have something to sell. The market could be a physical market like a retail outlet, Target, Kohl's, Walmart, whatever, where people can meet face to face, the retailer and the customer. Or it could be virtual, like an online market, Etsy, Amazon, what have you. And there's no direct physical contact between buyers and sellers. In terms of investing, people tend to look at their own domestic stock index as the market. So let me get this thing over here. Here we go. So in the US, most people would say the Dow Jones Industrial Average or the S&P 500 or NASDAQ, that's the market. And you can see these here. Here's the Dow Jones, S&P, NASDAQ for the US, and they're all based in New York. In Hong Kong, they'd say the Hang Seng. That's over here in Southeast Asia. Japan, they say the Nikkei. Germany would call it the DAX. For our purposes with Strategic Planning Corporation, we're talking about all of that. Our portfolios are globally diversified among those I just mentioned and all these others that you see here on this map. So when we're talking about the market rate of return, we're talking about a blend of all these indexes. And an index is just simply a basket of stocks and or bonds that represent a portion of a market, or even it could be the whole market, depending on how that index or that basket of stocks is structured. So now that we know what a market is, where do market returns come from? And I'll give you a second here to give me some suggestions on where market returns come from. Anybody has? I'll tell you what, for the sake of time, why don't I just tell you? So a short summarization of where market returns come from, it would be that stock returns are the outcome of business realities like earnings, okay? As well as market behavior, like the price of a stock compared to its earnings. So business reality, that's like the earnings, that tends to dominate over the long run of 10 or more years. Market behavior, on the other hand, can dominate over a shorter time period. And so I've got this little presentation here. It's going to be really difficult to hear if it works at all. We've had spottiness with it. But it's Jack Bogle who founded the Vanguard funds, and he's going to explain where market returns come from. You have to listen really closely, but I will summarize it when he's done. Let's see if it works. All right.
The mathematics of the market are eternal. Complex and mysterious as the stock market may seem, its returns are determined by the elementary internet interaction of just two simple elements, albeit two elements whose qualities are different as night and day. The first is investment return, determined by dividend yields and earnings growth. Investment return tends to be recurrent and steady. The second is speculative return, reflected simply in a change in the price earnings multiple, price an investor is willing to pay for $1 of earnings. Speculative return is intermittent and spasmodic. Add them together, we have the market return. It's that simple, it really is. And over time, it is earnings and dividends, investment return, that determine all of the return that's achieved by the stock market. Consider the past 40 years. Dividend yields plus earnings growth over that period came to a total of 11.2%. The actual return of the stock market was an identical 11.2% per year. In the long run, as it turns out, earnings and dividends call the market tune. But speculative return can be the driving force over short term and even over extended periods.
Okay, so what he's saying is there's two basic types of return that make up the total market return. Okay. In other words, what you get from your investment, what it produces for you. And he called the first one, he called the investment return. And that's where you have a company that pays out some of its profits in the form of a dividend. And then they have earnings on their sales and their activity in their company that produces a basis for that stock price to go up, because you're willing to put so much in to get that kind of money coming out of the company, growing the value of it. So dividends and earnings are called investment return. And then the other return that impacts the market return is speculative return. And he's saying that basically it's spasmodic. I like that term he used. It's intermittent and spasmodic. It comes in fits and starts, like the tulip mania, or like the tech bubble, or like the Japanese real estate bubble, and all these kind of things, cryptocurrency. It just jumps in there. It affects the market for a period of time. But in the long run, what he's demonstrating is that, in just for instance, looking back over the last 40 years, that the market's rate of return has been 11.2%. And if you look at the dividends and earnings, or what he calls the investment return, it's been 11.2%. So you've had all these crazy gyrations that have just been noise to just let the market do what it does. Do you have any thoughts there, Philip?
Basically, what I got from that, Mike, was there's two ways to make money in the stock market. You can speculate and gamble, in which case you might hit it big, but if you play long enough, you're going to lose, right? It's just like if you go to the casino.
Right.
Or you can just buy the whole thing and hold on to it. And that's what provides the steady returns versus the intermittent spasmodic effect of speculating and gambling. So
exactly. Yeah. And that brings us back to our original question of what is a good market return. So after all of that, you probably have some guesses. Just for sake of time, I'll move on. Because our portfolios are not plain, I have to say that the complicated answer as to what makes a market return is it depends. A good rate of return can't be a consensus number. It's not like you say, okay, so it's going to be 8%, or it's going to be 6%, or it's going to be 12%, or whatever, and everybody comes to a consensus. That's a good rate of return. There isn't any such thing as that. There's too many factors that go into each individual person's own situation and the way that they build a portfolio to say that a 6, 7, 10, or a 3% return is the return. And so what we have to understand, first of all, is risk tolerance. The individual, their personal tolerance for taking risk. How much exposure to the equity markets or the stock market is an investor comfortable taking? If somebody can stand a lot of variability in the value of their account over time, then they might want to be aggressive and have the vast majority of their money invested in the equity or stock markets. And over a lifetime, they would probably consider a good market rate of return to be close to double digits on average per year. If you were a little more hesitant and it wasn't comfortable to have, the market going up huge amounts and then dropping huge amounts and all this kind of stuff, but on average going in a tilt toward the right, on an upward tilt. If you were a little more hesitant, you might say, let's be a little more balanced and maybe put half of our money in stocks and half in bonds or fixed income. And a good market rate of return might be down close to half of what being all in on the equity market would be. If you are just overall adverse to stocks and the portfolio and just really looking to have a simple, no big risk return, then you're, not a lot of volatility and that kind of thing, then you're going to have a slightly less investing return over your lifetime. But this risk tolerance level, the amount of volatility or risk you're comfortable with, is not the only thing. You also need to understand your time horizon as an individual investor. The longer you have to invest, potentially, the higher the good return might be expected to be. Philip, did you have something you wanted to say there? We had talked about, I think.
Yeah, well, I'll just mention that, most of my clients vastly underestimate what their time horizon is. And I think, as we get older in general, we worry more about outliving our money. Mm-hmm. And so we think our time horizon is maybe shorter than it really is. But, when you look at the statistics, if you're in your 50s, you're expected to live more than 30 years. If you're in your 60s, you're expected to live more than 20 years. Even if you're in your mid 70s, your life expectancy is still 15 years. And then the biggest thing that I run into is clients forget to think about their beneficiaries, who are usually their children or their grandchildren, who certainly have, a much longer time horizon. So if you don't outlive your money, the people that you want to pass it on to. So I think when people look at risk tolerance and time horizon, they tend to look at how much money can I make? What's the upside potential, when they really should be looking at what's the worst case scenario? How much could I lose? How much, how much is this portfolio lost historically? What's the worst case scenario? And then I think on the time horizon, they really should consider their own life expectancy, but also the people who are going to be there that they want to provide for after they're gone.
Pass things on to, right?
Yeah,
exactly. So in order to understand this, this market rate of return that we should expect, you also need to understand an investor's philosophy. A lot of this information, in fact, all of this information that we're talking about here, as far as returns and the market returns, is based on a lot of academic research over almost 100 years. And the people that we draw from have actually ended up, because of their research and the things they've been able to demonstrate about markets and returns, has brought about the fact that they've won Nobel Prizes in economics for this kind of stuff. So, they are looking at a passive or a structured philosophy, where you're not trying to pick and choose companies to be in, or when to be in the market, when to get out of the market, or find somebody that can tell us when to do those things, or which companies to own and all that kind of stuff, which would be called an active approach to investing. And it's interesting that no one has ever won a Nobel Prize for having actively invested in and beaten the market over long periods of time. Because it doesn't help anybody, because how are you going to replicate that past experience in different markets that were based on speculative returns that were spasmodic and intermittent? I'm going to keep using that term. I love it. Yeah. So anyway, the philosophy is important. If you agree that, okay, if markets are efficient and they're random, and over time, they tend to produce these returns that are equivalent to what comes from just getting dividends and letting the value of the stock grow because of the earnings of companies. If just investing like that is good and will typically beat returns of people like Bernie Madoff, who were reporting stuff, but it wasn't real, then you tend to go that way. So you need to understand. Now, if your philosophy is, no, I think I can pick the winners and know when to get in and out, you don't want to invest like this because it's going to be totally frustrating. Might not be as frustrating as losing all your money one day, but it's going to be totally frustrating. So to look at all this kind of stuff and to how to figure out what expected returns, it's good to go back and look at some historical returns of the market. So going back 65 years, we're going to look at 20-year rolling returns in this case. So up to 20-year rolling returns. So this is an interesting chart. Let me just give you the bottom line here first. If you look up here in this white outline block, you'll see that the average annual return from 1950 to 2015, so 65 years, of stocks was 11.1%. I think Bogle said 11.2, so whatever. 100,000 over 20 years would have grown to $817,000. Bonds, the average return was 6%. 100,000 would have tripled to $321,000. And a portfolio that's half stocks, half bonds, or 50-50, did 8.9 and grew to about $554,000, $554,000. But this is what happened in the meantime. In 1 year of returns, the average, if you were just looking at 1950, at 1951, at 1970, at 1973, just 1 year at a time, over this 65-year period, the 1 year volatility levels ran from a loss of 39% as the worst case to a high of 47%. Okay, and that's of a blended bond and stock return. That's okay. So that's the blended return. The stocks, or excuse me, that's what this is here, the gray. The green is the stocks. The blue is the bonds. Goodness, I'm sorry. Okay, the blue is the bonds. So 43% on the high side, a loss of 8% on the low side for the bonds. So you can see a little less volatility. Nice on the high side, but a little better on the low side. So you take a little more risk of loss on the stocks than on the bonds. But if you blended the two, you're going to be somewhere in between here and just shy of there. So
and this is exactly what I was talking about with the worst case scenario. People tend to look at the average annual total return, 11.1. Oh, I'd love to have that. Give me 11% every year.
Right.
But what they really need to look at is your chart on the left that says minus 39%.
Correct.
Because if you can't sleep at night on the year that it gets minus 39%, you're not going to stay in it long enough to get the 11% over the long haul.
Right. Yep. Yeah, exactly. And so, that's for 1 year. So, you can see the volatility is pretty wide over 1 year for the stocks, also for the bonds, but not as much. And for a mixed, balanced portfolio, a little less volatility to the upside and the downside. For a 5-year rolling period, so in other words, you're looking at 5-year blocks of time, 1950 to 1954, 1955 to 1960, things like that, or 6 now, whatever it is. The stock highest average annual return was 28%. The lowest was -3. Bonds -2, about the same, 23. You can see a little bit less. The balanced portfolio, not bad, right in that same range, 21% on the high side, positive on the downside. If you go to 10 years, so we're looking at decades, 19 on the high side for the stock portfolio, 100% stocks, -1 on the downside. 16% on the high side for bonds, 1 on the downside, +1 on the downside, or the low side, I should say, for bonds, and then 2 to 16% on the balanced portfolio. And then finally, if you're looking over 20-year periods of time, so going back to this, how long are you going to be invested? If 20 years is in your picture, a stock portfolio, a more aggressive approach, 17-7, but a balanced approach, 14-5. I mean, it's not that much difference. And then just bonds 1-12.
And
So
I think if you look at it, if you think about it, like if you build your portfolio for that 20-year period, you don't have to worry about what's going to happen in the next 20 months.
Right. Exactly. So, I mean, if you are comfortable with being more aggressive, you'll pick up a little extra return likely. And even at the worst case scenario, you'll still have the best return. If you are less inclined to take a full stock market risk, I mean, goodness gracious, it's still very, very reasonable. So this helps us understand that a good return is, or what a good return is if we invest in the market. So the work we need to do as individual investors is figure out what's my risk tolerance. How long am I going to be invested? How long is this money going to be invested? Maybe it won't be in my hands, maybe it'll be in my kids' hands or a charitable organization's hands or something like that. And if we can lock those things down, then we can start to have proper expectations of what a market return is, and you can then get your share of it. If you know what to expect, you can stand up to the temptations of chasing these triple-digit returns, being seduced by family members, friends that are telling you these great otherworldly stories of returns that they've gotten, and leaving out the bad ones. You know, they tell you the good stuff. And so instead of potentially being late to the game or to the party or whatever, you can invest in a portfolio that you can understand, you can have proper expectations, and instead of being left holding the bag and chasing some of these speculative things that are out there, you can truly get what is your share for the way that you invested and get peace of mind financially over your investments. And that's something that we have to do battle with every day, because there's all kind of stuff coming at us trying to tell us that we need to be doing this or that and protect from that and take advantage of this. You know, it's going to take battling that to truly understand returns. And it happened to me. I went from this internet tech genius to individual investing for others as an advisor. And it's not until I looked at myself and understood what a true market rate of return was that I stopped gambling and really started investing. And what helped me get over this hump was coming to an understanding of my philosophy of investing and then aligning my actions with my values. So, you know, we spent a good amount of time to come to this conclusion that it's important to understand returns. Not only will it help you set proper expectations, it will also help you avoid getting sucked into chasing unrealistic returns and then gambling instead of investing. And it will give you investment peace of mind, like I said, and allows you to help others achieve that for themselves by telling the story. I don't want you to be left out on the sidelines when everybody's telling a story or be swayed by someone else's story of returns, but having the confidence and education about your returns, that will give you the power to participate in that investment banter and help people avoid pitfalls and get tied up in tulip mania or housing bubbles or tech bubbles or things like that, or chasing Bernie Madoff deals or 55% plus crypto investors going underwater. All these temptations, they'll be coming down the pipeline to you. So you want to turn into someone who hated being left out to being the belle of the ball. But all joking aside, if I had to go back to Michael Scott from the beginning, you know, make that connection. But it only helps you if you have confidence and understanding around the returns that will help you in talking with other people and talking to yourself, preaching to yourself about what's the right way to go at things. 50% growth every year is great, but the easiest way to sustain and continue that is to be helping your friends and family, because you're building into them a lot of good stuff. So what we want to do is reframe the conversation, control the conversation to help them be able to understand it. So for you, it's about being confident in your financial path and not being swayed by today's flavor of the month. So with that, Philip, what do we want to do today?
Well, I don't know. I wrote down when my camera was off some rules. I don't know if you can see this.
Okay.
But you know, when you're thinking about yourself or somebody else, either one, you do want to own stocks, you do want to diversify, you do want to rebalance, you don't want to stock pick or try to time the market or put your money with somebody who did good last year in the hopes that they'll, you know, have a repeat performance, because those are where things go wrong. And then the other thing I'll just mention, just because of my clientele in the law firm, is be grateful for whatever returns you have. You know, if you're ungrateful, no amount of money is going to make you happy. It's not going to be enough. So so we talk a lot about money, but but honestly, you can have millions of dollars and be miserable, or you can have $100,000 and be very happy.
Yeah, for sure. So that brings us to the end of the formal presentation. I don't know if there are any questions. I'm not seeing any questions. That's because we did such an incredibly good job. Let's see. Oh yeah, actually we did. Okay, here we go. Buying, selling of goods. I'm sorry, I missed some of these other things about what is a market. But there was a question over the same time periods, 1, 5, 10, and 20 years. So I guess that's going back to this chart. Let me see if I can get there. There we go. Going back to this chart. What's the inflation rate? Oh, interesting. Yeah. You know, I don't know off the top of my head, but the average inflation rate from the 70s until the mid 2010s, so right, probably about to this 2015 range, was 4.25%. That was the average annual rate of return. But you know, this 1 year is 1 year in 1950, 1 year in 1951, 1 year in 19, you know, so forth. So this covers 65 years of 1 year returns. This covers 65 years of average per 5 years return, and average of 10 years and then 20 years. So over this time frame, the inflation rate probably is run somewhere around the 3 to 4% range. In the more recent period of this 1 year return here, you know, it's been, what was it, 10, I think, or something like that. But hey, back in the early 70s, well, actually not early 70s, sorry, late 70s, it was 12, 13, 14%. It's crazy. Anybody buy a house back then? You had a pretty high mortgage rate. But yeah, so it's average over that time, 3 to 4%, somewhere in that range. But I didn't do any research to know that off the top of my head.
And let me ask you this.
Yeah.
What's the average investor return?
It has been right around 3%.
Yeah. So, you know, not even really keeping up with inflation.
With inflation, right. Yeah, and that's because a lot of what we talked about today is chasing speculative opportunities, gambling rather than investing with your money. So you're going to see these things, just to wrap this up, you're going to see these things come along that are going to try and grab your attention. The news media, the financial media, they're great at throwing this stuff out there. Your email inbox is probably flooded with all kind of scary headlines about what you need to do to, you know, make money and thrive. I'm getting these emails that are telling me I can do 20 to 25% a year easy. And I've even got some others that are telling me in that 70, 80%. And it's not crypto, it's real estate, of all things. Anyway, crazy stuff. And the key is keep your head, understand where returns come from. They do not come from these speculative, spasmodic events. They come from dividends and earnings in the growth of these companies over time. So you just, like as Philip said, own the market, keep it. And you know, one of the nice things of what we do is we rebalance periodically so that we're buying more stuff when it's low and selling it when it's high, and just keep on doing that. Buy low, sell high, and that helps bump up the return a little bit. So hope this has been valuable and helpful to you. If you are a client of ours, and most of you on this call are, we want you to feel free to contact us at any time for anything you might need. We offer some things like evidence-based diagnostic reports where you kind of analyze how you're set up, and we can do that for other assets you might ill-advisedly have elsewhere and help you understand how they match up with what you're doing with us. But we also want to encourage you that if you have friends or family members that you could help with this kind of discussion, introduce them to us. We'll be glad to work with them and help them to achieve some of the same peace of mind that we hope you have. With that, we'll sign off for today. Again, feel free to call us at any time with anything that you have on your mind, and we look forward to seeing you more later this year. Have a great day, and talk to you soon.